Markets open in 8 hours. Silver $84, gold eyes 5,200, oil 115, war economy. 8 hours, that is all that stands between you and what could be the most consequential market open of the decade. Silver is draining from Western vaults at a pace not seen in modern history. Gold is no longer just rising, it is targeting a number that was once called impossible. Oil at 115 is not a price anymore. It is a message. And somewhere behind closed doors, institutions that never announce their moves are already positioned. The question is not whether something is coming. The question is, are you going to be the one who saw it first or the one who reads about it after it already happened? Welcome to Financial Crisis Explained, the one channel where the numbers are never dressed up and the truth is never softened. Now, before we go any further, if you have not subscribed yet, think of it this way. You would not leave the house in the morning without putting on your glasses, would you? Subscribing to this channel is exactly that. It is how you see clearly in a world that is deliberately kept blurry. One button, that is all it takes. Do not let the algorithm decide when you get this information. You decide. Hit subscribe right now. And one more thing, we are a global community here. So tell us, where in the world are you watching this from today? Drop your city, your country, just your continent, whatever you are comfortable with. Because from Karachi to London, Lagos to New York, and what happens in the next 8 hours affects every single one of you. Now, let us get into it. The numbers are waiting. 8 hours. That is the window. Not a warning, not a theory. A countdown. While the average person spends this weekend scrolling, resting, and convincing themselves that the economy is someone else's problem, somewhere in Zurich, in Shanghai, in Geneva, and in the quiet offices of institutions that never appear on television, serious capital is being moved, quietly, deliberately, without announcement. This is not speculation. This is pattern recognition. And the pattern right now is speaking at a volume that cannot be ignored. To understand what is happening this weekend, one must first understand a fundamental truth about financial markets that business schools rarely teach in their first year. Markets do not sleep. Only the average investor does. The Chicago Mercantile Exchange, the CME, closes on weekends. The New York trading floors go quiet. The tickers slow down, and the financial media shifts to commentary, opinion, and noise. But underneath that surface silence, the real market never stops moving. Tokenized gold trades through Saturday. Physical silver changes, hands in Shanghai while London sleeps. Oil futures get repriced in real time as geopolitical developments unfold in regions that never observe a Western weekend schedule. The weekend is not downtime. The weekend is intelligence time. And right now, the intelligence coming through every credible channel is pointing in one direction. Let us establish the macro backdrop first, because no asset, not silver, not gold, not oil, exists in isolation. Every price is a reflection of the system that surrounds it. The world in 2025 and into 2026 is no longer operating under the economic assumptions that governed the post-World War II era. The framework of globalization, cheap energy, stable supply chains, and cooperative monetary policy, that framework is fracturing. What is replacing it has a name that economists are increasingly unwilling to say out loud in polite company. A war economy. Not a metaphor, not a political statement. A structural, measurable, documented shift in how governments are allocating capital, how central banks are accumulating reserves, and how the largest sovereign wealth funds on the planet are repositioning their holdings. Defense spending globally has reached levels not seen since the Cold War. Energy infrastructure is being nationalized, rerouted, and weaponized as a geopolitical instrument. Supply chains that once moved on efficiency are now being rebuilt around security. This is the backdrop. This is the context in which silver sits at $84, gold eyes $5,200, and oil holds at $115. These are not random numbers on a screen. These are readings on a system under extreme stress. Now consider what the weekend reveals that the trading week conceals. During active trading hours, institutional players have every incentive to manage perception. Prices get defended, narratives get constructed. Algorithmic trading creates the illusion of stability even when the underlying fundamentals are anything but stable. But on weekends, the mask slips slightly. Physical metal moves. Vault receipts update. Shipping manifests get filed. Diplomatic cables get sent. And for those who know exactly where to look, the signal becomes unmistakably clear. This weekend, 3 simultaneous signals are converging in a way that any serious economic analyst cannot dismiss. Western silver vaults are draining. Eastern buyers are paying a significant premium above the Western paper price. And gold, the oldest monetary asset in human civilization, is being accumulated by central banks at a pace that has not been recorded in modern financial history. These 3 facts, taken together, do not describe a market behaving normally. They describe a market preparing for something, So here is the question that every serious businessman, every aspiring entrepreneur, and every decision maker in this audience must sit with before Monday morning arrives. When the bell rings in 8 hours, when the screens light up and the tickers start moving again, will you be reacting, or will you already understand exactly what is happening? And why? When two metals move together, empires have always followed. There is a conversation happening right now between two metals. It is not loud. It is not on any financial news ticker. But for anyone who understands monetary history, it is the loudest conversation in the room. Silver at $84, gold eyeing $5,200, and the gap between what the paper market says these metals are worth and what the physical market is actually paying for them is growing wider by the day. This is not a trading opportunity. This is a warning signal embedded inside a price chart. Let us begin with silver, because silver is where the story always starts. Before gold makes the headlines, before the mainstream media catches up, and before the average investor realizes what has already been in motion for months, Western spot price currently sits at $84 per ounce. That is the number most people see. That is the number that gets quoted on financial terminals, discussed on business channels, and referenced in weekend market summaries. But there is another number, one that does not appear on Western screens with the same frequency. In Shanghai, physical silver, real deliverable allocated metal, is being priced at $96 per ounce. That is a $1,200 gap. $12 between what the paper futures market in the West says silver is worth and what buyers in the East are actually willing to pay for the real thing. In normal market conditions, this gap does not exist. Arbitrage mechanisms close it almost instantly. When paper and physical diverge significantly and persistently, it means the paper market is losing its grip on reality. Now add the vault data. Because numbers on a screen can be manipulated, but physical inventory cannot lie. COMEX total silver inventory recorded 349 million ounces as of last Thursday. That sounds large, but it is the direction that matters, not the size. 9 consecutive weeks of net declines. In a single recent session, 2.22 million ounces left COMEX vaults in one day. The weekly drain came in at 8.4 million ounces, nearly 262 metric tons of physical silver removed from Western storage in a single week. Simultaneously, across the Atlantic, LBMA London silver inventory dropped 2.4% in February alone. London vaults now sit at 870 million ounces and falling. Both major Western vaults draining. At the same time, this is not seasonal. This is not routine. This is systematic physical removal at a scale that rewrites supply assumptions. And when supply assumptions get rewritten, price assumptions follow. Always, without exception. It has never worked any other way in recorded economic history. Now turn to gold, because gold does not move to $5,200 without a reason. And the reason is never simple. It is always structural. Central banks globally have been accumulating gold at a pace that has broken every post-Bretton Woods record. Not one central bank, not a handful of emerging market economies quietly hedging currency risk. Major sovereign institutions across multiple continents, simultaneously. They are not buying gold because they expect inflation to tick up slightly next quarter. They are buying gold because they are preparing for a monetary environment that looks fundamentally different from the one the world has operated under since 1971. The $5,200 target is not a speculative price point invented by optimistic analysts. It is the mathematical destination of the accumulation trend currently underway, if the pace of central bank buying holds at even half its current rate through the next 18 months. Here is what history records about moments like this one. When silver drains from Western vaults, while simultaneously commanding a premium in Eastern physical markets. When gold is being accumulated by sovereign institutions at record pace. When both metals move in the same direction at the same time with this level of structural confirmation behind them. It has happened before, 3 times in the last 50 years. Each time, what followed was not a market correction. What followed was a fundamental restructuring of the global monetary order. The first time, the world abandoned the gold standard entirely. The second time, inflation consumed an entire decade of middle-class wealth. The third time, the financial system required the largest coordinated bailout in human history just to remain standing. We are looking at the fourth signal. This is not an energy price. This is the cost of a world reordering itself. There is something about the number $115 that deserves more than a passing glance. Most analysts will frame it as an energy price, a supply-demand equation, a reflection of OPEC decisions and refinery capacity and seasonal consumption patterns. And they will be partially correct, but only partially. Because $115 oil in the current geopolitical environment is not simply the result of market forces finding equilibrium, it is the result of something far more consequential. It is what happens when energy becomes a weapon, and the world has not fully processed what that means yet. To understand oil at $115, one must first understand what oil actually represents in the architecture of a modern economy. Oil is not simply fuel, it is the invisible ingredient inside everything. The fertilizer that grows the food, the plastic that packages it, the diesel that moves it from farm to factory to port to shelf, the aviation fuel that connects global supply chains, the petrochemical base that manufactures the medications, the textiles, the electronics, and the industrial machinery that the modern world depends on without a second thought. When oil reprices, everything reprices. Not immediately, not visibly, but systematically, quietly, and without mercy. A $20 increase in the price of oil does not stay inside the energy sector. It bleeds outward into every cost structure in every industry in every country on the planet. It shows up in shipping rates 3 weeks later, in food prices 6 weeks after that, in manufacturing costs 2 quarters down the line, in consumer inflation numbers that politicians will spend the following year trying to explain away. This is the transmission mechanism that most market commentary ignores entirely. Oil is not a commodity. Oil is an economic multiplier. And right now, that multiplier is set to $115. Now examine why. The surface explanation is simple enough. Active conflict in key energy-producing and energy-transiting regions has introduced a war risk premium into every barrel of oil traded on global markets. Shipping routes that once carried crude through predictable corridors are being rerouted. Insurance costs on maritime oil transport have risen sharply. Certain ports and transit choke points that the global energy system quietly depended upon for decades are no longer reliable. But the deeper explanation goes further than shipping routes and insurance premiums. Sanctions architecture has fundamentally altered the geography of global oil trade. Countries that once bought Russian oil through straightforward Western intermediated channels are now constructing entirely parallel trading systems. New payment mechanisms, new shipping arrangements, new refining partnerships that deliberately bypass the dollar-denominated infrastructure that has governed global energy trade since the 1970s. This is not a temporary workaround. This is the construction of a parallel energy economy. And parallel economies, once built, do not dismantle themselves when the conflict that created them ends. They persist, they expand, they become the new architecture. Consider the historical parallels, because this pattern has appeared before, and the consequences were never minor. In 1973, the Arab oil embargo did not simply raise prices at the petrol station. It ended an era of cheap industrial expansion, triggered stagflation across the Western world, and forced a fundamental restructuring of how developed economies thought about energy dependency. In 1990, the Gulf War oil shock did not simply spike crude for a quarter. It exposed the fragility of supply chain assumptions that corporations had built their entire cost models around. In both cases, the initial price movement was dismissed by mainstream commentary as temporary. In both cases, the structural consequences lasted for a decade. The $150 price today carries the same structural fingerprint. It is not a spike. It is a settlement. A new floor being established under conditions that are not resolving, they are deepening. And here is where oil connects directly back to gold and silver, because $115 oil means persistent inflation. Persistent inflation means currency erosion. Currency erosion means the purchasing power of every dollar, every pound, every euro sitting in a savings account is being quietly redistributed away from the people who earned it. This is not a conspiracy. This is arithmetic. And it is precisely why central banks are buying gold, and why Eastern buyers are paying $96 for silver that Western paper markets price at $84, why the vault drains are accelerating, why the signals across every asset class discussed in this analysis are all pointing in the same direction at the same time. Oil at $115 is not the problem. Oil at $115 is the confirmation. The confirmation that the war economy is not a phase. It is not a temporary disruption between two periods of normalcy. It is the new operating environment, and every business, every investment portfolio, every financial plan that was built on the assumptions of the old environment is now being stress tested against a reality it was never designed to handle. The question for every serious decision maker in this audience is not whether this is happening. The evidence is overwhelming. The signals are confirmed. The historical pattern is documented. The question is far simpler and far more urgent. What are you going to do about it before Monday morning arrives? While the world reacts, serious capital has already moved. There is a defining characteristic that separates every major wealth preservation story in recorded economic history from every major wealth destruction story. It is not intelligence. It is not access to information. It is not even capital size. It is timing. Not the timing of a trade, the timing of a decision, the decision to stop interpreting the signals as noise and start treating them as instructions. Because right now, in this 8-hour window before markets open, the signals are not subtle. They are not ambiguous. They are not open to significant interpretation. They are explicit, and they are urgent. Let us be precise about what serious institutional capital is actually doing right now, because this is not speculation. This is observable behavior, visible in vault receipts, in central bank balance sheets, in shipping manifests, in sovereign wealth fund disclosures, and in the quiet repositioning of portfolios that manage more wealth than most nations produce in a decade. First, hard asset accumulation is accelerating. Not rotating, not rebalancing, accelerating. The distinction matters enormously. A rotation suggests a temporary shift in preference, moving from one asset class to another within a normal risk management framework. What is happening right now is categorically different. Institutions are moving into physical gold, physical silver, and energy-linked assets with a conviction and at a pace that signals one thing clearly. They do not believe the current monetary environment is going to stabilize. They believe it is going to deteriorate further, and they are positioning accordingly, not for the next quarter, not for the next fiscal year, but for a structural shift that plays out over the next several years. This is the single most important piece of intelligence available to any serious investor or business owner this weekend. Second, liquidity is being preserved with surgical precision. In a war economy, cash is simultaneously the most dangerous asset and the most necessary one. Dangerous because persistent inflation, driven by $150 oil, driven by supply chain restructuring, driven by defense spending that shows no sign of contraction, is eroding the real value of cash holdings every single day. Necessary because opportunities in dislocated markets require the ability to move quickly, without leverage, without dependency on credit systems that themselves become unreliable in periods of systemic stress. The strategic response is not to eliminate cash. It is to minimize the duration of cash exposure while maximizing the optionality it provides. Serious capital is holding liquidity not as a long-term store of value, but as a loaded weapon pointed at specific opportunities that war economy dislocations will inevitably create. Third, supply chain dependencies are being audited and restructured. This applies not just to institutional investors, but to every business owner watching this analysis. The war economy does not only reprice financial assets, it reprices operational assumptions. Every business that sources materials internationally, ships products across borders, prices services in a single currency, or carries debt at variable interest rates is currently operating with risk exposures that were not part of its original business model. The businesses that survive structural economic transitions are not necessarily the largest or the most profitable. They are the ones that identified their dependencies earliest and restructured before the disruption forced them to. In 1973, the companies that had already begun diversifying their energy suppliers before the embargo hit did not just survive. They gained market share from competitors who were caught unprepared. The window to make those decisions proactively is always shorter than it appears. Now, before markets open, here are the specific signals that every serious observer should be monitoring in the final hours of this weekend. Watch the tokenized gold price. If it moves significantly before CME opens, institutional positioning is already underway, and the Monday open will reflect that movement with force. Watch COMEX silver inventory updates. Any further drain confirmation before the open reinforces the physical squeeze thesis and suggests the $84 paper price is increasingly disconnected from physical reality. Watch oil futures in Asian markets. If Brent crude approaches or tests $118 in overnight trading, the war premium is expanding, not stabilizing, and every inflation-linked asset class will respond accordingly. Watch central bank communication. Any sovereign institution that issues a statement regarding reserve composition, gold holdings, or currency policy this weekend is not doing so accidentally. In a war economy, there are no coincidences in central bank communication. But beyond the specific signals, beyond the individual asset classes, beyond the charts and the vault data and the geopolitical analysis, there is a framework that every serious decision maker must internalize before Monday arrives. War economies do not destroy wealth uniformly. They redistribute it from the unprepared to the prepared, from the reactive to the anticipatory, from those who trusted the paper narrative to those who read the physical reality underneath it. Every major war economy in recorded history, from the First World War commodity supercycle to the 1970s stagflation decade to the post-2008 quantitative easing era, produced both catastrophic losses and extraordinary wealth preservation stories. The difference was never luck. The difference was always the quality of the decision made before the bell rang. Silver at $84 while Shanghai pays $96. Gold eyeing $5,200 while central banks accumulate at record pace. Oil at $115 while the war economy rewrites every supply chain assumption on the planet. 3 assets, 3 signals, 1 direction, and 8 hours on the clock. The institutions already know what these signals mean. The question that this entire analysis has been building toward is whether you do too. Because when those screens light up on Monday morning, when the tickers start moving and the volume starts climbing and the headlines start explaining what is already happening, the decision window will have closed. The prepared will already be positioned. The unprepared will be reaching for their phones, trying to understand what they missed. The clock is still running. 8 hours was the beginning of this conversation. How many hours remain now is entirely up to you.